what am I going to do next? I'm not the kind of guy that's going to sit on a beach or play golf all day. I build cool stuff because I love building cool stuff. And chocolate finance is an outcome of all the learnings that I've ever learned in my life. And now it's playing out just brilliantly to deliver what it is that we're now going to be delivering with chocolate finance.
Then the obvious question for me is, tell us a little bit about chocolate finance. Joining me from sunny Singapore is the founder and CEO of Chocolate Finance. His name is Walter De Oude. Sometimes when the concept is very unique, which in your case it is, right? It's sometimes very hard to get investors onboarded because let's be honest, the vast majority of investors prefer the herd mentality. They love being a part of the collective because they feel that they've diversified their risk.
So we're going through a process now which will re-up the cap table as we go through that next phase. We don't need a lot of capital actually because the execution stuff is very, very light, but we do need solvency type of buffering as we grow.
Agents are going to replace, AI agents are going to replace all of us.
Not all of us. I think there's a lot of guys, a lot of people have to make the agents.
Yeah, well, fair.
And a lot of them have to tell them what to do. But I think that that's a real evolution coming, which is actually in the best in consumers' interest, right? I'm a consumer guy. How do we create good value for customers?
Hello, ladies and gentlemen. Welcome back to the next episode of Couchonomics with Arjun. Joining me from sunny Singapore, I don't know if it's sunny or rainy, I'm sure Walter will let us know, is the founder and CEO of Chocolate Finance. His name is Walter De Oude. I hope I got the pronunciation correct. Walter and I met last year at Singapore FinTech Festival, and we actually had quite a nice little chat on the side for about 15 minutes when I was doing something with Founders Peak. But I thought, why not bring him to the main event, which is the podcast here. So with that, Walter, welcome to, as I have to call it, the virtual couch because you're not in my studio.
Happy to be on your virtual couch, Arjun. Thanks for thinking of me and being eager to hear what I have to say.
Now we look forward to hearing from you and your name, the name of your company, Chocolate Finance, has fascinated me since we first met, and I saw that T-shirt that you were wearing, which I'm still eyeing. So Walter, let's start. There's a lot I have to cover because you have a very interesting sort of career and a background too, with your experience in SingLife and now Chocolate Finance. So we're going to feel our way through this conversation. But my first question is, you founded SingLife, you took it to a very impressive scale, right? Now you founded already Chocolate Finance. What inspired you to sort of do this new venture?
Well, of course, I just love building cool stuff. What can I say? I mean, you built the first one, SingLife. SingLife was a great success. SingLife was designed to re-engineer how we thought about life insurance. We built digital and technology and stuff to deliver a far superior customer experience around the space that I was good at the time. I was an actuary by training, and so insurance was my thing. And so I thought, let's build a life insurance company, and that worked really, really well. As time evolved, my time at SingLife came to an end, and I thought, well, what am I going to do next? I'm not the kind of guy that's going to sit on a beach or play golf all day. I build cool stuff because I love building cool stuff, and chocolate finance is an outcome of all the learnings that I've ever learned in my life. And now it's playing out just brilliantly to deliver what it is that we're now going to be delivering with chocolate finance.
Okay. So then the obvious question for me is, tell us a little bit about chocolate finance.
Well, chocolate finance originated from an idea that we had at SingLife about how can we get people to get a better return on their spare cash. Yeah. Mm-hmm. The view came at SingLife when we were building insurance policies, and how do you sell more insurance policies, right? And everything is always around distribution. And the distribution was either direct to customer or advised. But actually in life insurance, the best possible distribution is actually bank assurance, right? If you can get access to someone's cash and his finances, you can have much more engaged dialogue around broader financial services. Now, when I was at SingLife, obviously we were a smaller company. We didn't have the big budgets to go and buy bank assurance deals, and all the banks were taken anyway. So I thought to myself, well, so what? I'll just build my own bank, right? And so what we did was we built a product, which was an insurance product, which you could put money in any time, take money out at any time. We put an interest rate or crediting rate on it. I put a debit card on it and a phone app that looked like a bank, spoke like a bank, and did what banks did. And people loved it, right? And what we found was that people engaged with it in a way which was far superior than anything any insurance company had ever done. We put $1 billion and 100,000 customers on the platform in like 7 months. And the money was super sticky because the yields were just better than what you were able to get on your traditional bank accounts. The problem with the things that we did at SingLife and most traditional financial services companies, that these products are very capital intensive. Yeah. And so as you grow very big and scale it a lot, you have to set aside quite a lot of capital to do that. And so the inspiration for chocolate finance was really the same simple need of everybody. Everybody's got cash in a bank doing nothing. Yeah. Like next to nothing. Most people will move some of their money, not all of their money, to a higher yielding account if it's easy to do. Yeah. And once it's there, it's sticky because you don't spend your higher yield money, you spend your low interest money. And if we can build that in a way which is super engaging, we've got a real top of a funnel for how to deliver value to customers. Yeah. The beauty around Chocolate Finance relative to the learnings I'd had previously is Chocolate Finance operates as an asset management company rather than as an insurance company. And because of that, customers' monies are not put on my insurance company's balance sheet. They're put on an asset management custodized account. It's a ring-fenced, segregated block of assets. And because it's ring-fenced and segregated, there is no capital inefficiency or capital to hold to support those assets, which means that Chocolate Finance can scale infinitely. And that's really the genesis of where Chocolate Finance began.
Okay. So, us simple minds, we look at inefficiencies, we look at demographics, we try and build products which kind of meet a need which is, I guess, underserved, or a segment that is underserved. Who does Chocolate Finance target? Because this could be the entire market, but is there a particular segment that you're specifically focusing on, or is it for everybody?
Yeah. So marketers are very good at trying to segment customers into boxes. You've got Gen X's and all of these things. So we started out by trying to look at specific customer segments that we were focusing on. We were looking at lazy savers is a segment, right? People just want to put their money somewhere and forget about it and let it go. Or optimizers. There are a lot of people that just look for the best rate in town and move stuff around. Mm-hmm. But what we find is that in financial services, what we're really looking for is power users. Yeah, we call them power users, people that are understanding what's around and available, but there is so much choice that people prefer to pick something that resonates. And so within that, you kind of get this group of people, which is either, age or generation based, technologically based, or convenience based. Yeah. And then the intersection of that somewhere is where Chocolate Finance fits in. We are just a very simple place where you put your cash, it earns a better return, and you can take it at any time. That particular solution is valuable to everybody. But when it comes down to branding and positioning, the name Chocolate Finance itself resonates in a certain way. Generally, a Chocolate Finance brand speaks to a younger, actually slightly more feminine audience, because people are looking to try new things in the spaces that we're trying to operate in. And that's where the resonance comes from.
And you've been around for how long now?
So we launched the business in 2023. We did a pilot in August 2023, and we thought we were super cool. We did a 5-week program to get ourselves live and up and going, and we did about 5,000 customers and 65 million in assets in about 5 weeks. Boom, with no marketing, no nothing, just a little bit of social media and a little bit of talking about stuff. We then had a pause as we kind of reconfigured some of our licensing, worked with the regulator through how we were going to optimize certain things that we weren't able to do previously. We relaunched it again in July of 2023. We moved the existing customer base onto the new licensed platform, and we've been pumping ever since. So, but it's basically 13 weeks since July that we've been going.
Okay. And so my question is, obviously it's early days, but is the demographic that is coming on board on the platform reflective of what you just said earlier today in terms earlier in the show, which you said younger, feminine, or is it more wider in the sense, are you actually picking that niche up?
Yeah, it's a little bit wider than we thought because the need is quite universal, right? We did think that you'd get an early adopter phase, and then you'd get a more later stage adopter, and the early adopters are the people that read Reddit, for example, are early adopter kind of people, and which did have this kind of younger 25 to 40 age group in the early phases. But what we then started to see was that because a huge amount of our model was referral based
Mm-hmm.
for our customer acquisition, this group of customers then started to refer to their number one, their peers, but secondly, to their families. So we then started to get mothers and fathers and grandparents coming onto the platform all through the referral period, because actually everybody has the same simple need for enhanced cash returns. So we started to get little bubbles, and then slowly over time, we're expecting to get closer towards a population pyramid kind of exposure. But that said, as I said, we have been fortunate to have a higher proportion of female customers on the platform, which is unique in our space. Most fintech or tech related projects tend to have a slightly more male customer slant, and so we're very happy that we were able to give something new to a broader segment of the market.
No, I think it's quite interesting. I've got a couple of questions on that, but before we go there, I wanted to get a bit more clarity in terms of, so from a regulator's perspective, how do they see you? You use the word, an asset management platform, but at the end of the day, you are sort of, if I may say, a high yield savings platform. So how does the regulator see you?
So we are licensed in Singapore as a fund manager. We have a capital market services license. So we're an asset manager, right? And everything we do is using an asset management chassis.
Mm-hmm.
That means that customers' monies are invested in portfolios of short-term fixed income bonds, which is the asset that backs the returns that generate the yields that are available for customers.
Okay. All right. That makes sense. All right. And that makes sense. And my question then is, obviously it's too early days, but the intention is then as you collect more and more of this money, I guess you start to profile the customers a little bit more in terms of, what their risk appetites and their return appetites are and the amount of money they want to put into it. And then I guess you sort of evolve from that perspective into becoming something more, I guess, bigger and more niche, and especially with women coming on board, I guess there is an element that, the product might actually head in that direction. Is there some early thinking on that yet, or is it too early to call that?
Yeah, of course, every business has to start somewhere and then grow from there.
Mm-hmm.
When we talk about building businesses, it's how do we constantly increase the lifetime value of a customer? And that generally comes with the addition of additional products and services as you come to market. Now, as an asset management company, we have the capability to do all things asset management, right? I can offer you retirement funds and choice and advice, and I can do all of that stuff within my licensing capabilities. But we chose to be very niche at outset. We only wanted to be known as Chocolate Finance for doing one thing, doing it really well, and that was enhanced cash-like returns.
Mm-hmm.
Yeah, and we do that specifically because of how consumers think. We have a world that we live in where humans are faced with so much choice.
Complexity, yes.
So much choice. How do you get a product in front of customers where they can say, yep, I need some of that? Now you think about an asset management company, I can come to you and say, Arjun, I can give you X% return on your cash and you can take your money out at any time. Or I can say, Arjun, I'm an asset management company and I've got 20 funds on my platform, and whatever you want to do, you can come in and do it on my platform. If I gave you that second positioning, how am I different from anyone else of the other 40,000 asset managers there are out there in the world? But Chocolate Finance is the only one that's coming through to say, I'm going to solve your spare cash management problem. So regardless of where I'm going to go in the future, the starting position for how to acquire customers is through the top of the funnel. And that in my world is cash and enhanced yield. mean, different companies have attacked the market entry problem in different ways. And everybody that has been incredibly successful has focused on one specific pain point first before offering other services. I'll give you my favorite example is Revolut, right? Revolut is $45 billion valued neobank / bank. They focused when they started on one thing, which was FX, right? FX was a pain point. It's no longer a pain point for our customers, but that was the thing at the time. And they focused on that first and then built ancillary products and benefits around that to form the kind of business that they are now. And so our expectation is to take this different pain point, which is enhanced cash or the lack of yields that people are getting on their traditional cash management solutions, and use that as the top of the funnel to build broader financial services around that as time goes by.
Fair enough. But my question, so let me push this question slightly differently. The entry point I get, I think, it's unique in the sense that I don't know many other businesses which are doing that. If they are, it's just my ignorance rather than anything else. Question here is, with a narrow offering, right, how do you actually grab attention in a world where there is so much complexity, so much choice, and so many people grabbing that attention from the end customer, right? Are you going to be, or are you already embedding your product into some other products which customers are more easily accessing and therefore they see this as an adjacency? Or are you saying, no, we'll spend that money up front in terms of cost of customer acquisition and through the referral model we'll grow the business? Are you going to start working with wealth managers? In the sense, scaling a business like this could be expensive in my humble opinion. I'm happy to be proven wrong.
Yeah, sure. So to your first point, in a crowded market, how do you stand out, right? And you stand out by doing a product or service which is unique, different, and that people actually want. And that's where Chocolate Finance started. The second part of how Chocolate Finance has been successful so far is cutting through from a branding perspective. The name Chocolate Finance is not a fleeting idea. There's a lot of science behind how to position brands in a way that are memorable. For exactly the same reason when we first met, the name Chocolate Finance intrigues you. It intrigues everyone, right? And so it's something you're not really going to forget. So when you see a billboard or a poster or something with a Chocolate Finance branding on it, you can get immediacy of cut through is what the marketing guys will call it. From a cost and acquisition perspective, we get at the moment 50% of our customers come through from referrals. Yeah. And the referral program in our case is $5 a referral, right? So cost of customer acquisition is tiny in the scheme of things. We do obviously the traditional online media type of acquisition tools, plus a huge amount of influencer marketing that happens at the same time. When we launched, we did spend quite a considerable amount of money in brand positioning. And, like they say, you only get one chance to make a first impression, so it better be a good one, right? So we had a lot of thought and effort went into that. My good friend Henry Golding from Crazy Rich Asians joined us as a
I was going to ask you that as the next question, but good. Go ahead, please. I want to hear more about that.
And we've had a lot of fun, but most importantly, the results have been unbelievable. I mean, we've blown away every initial expectation that we had in terms of how well this thing would do. And it seems we've just hit a real pain point for customers that people are subscribing to, and the ease of the journey and the elegance of the solution is speaking to a lot of people. And, it's doing well when people are telling their friends and increasing their balances. Yeah.
So you obviously answered the question around Henry. There's also, you've attracted a number of sort of high-profile investors, right? I think the question is not why and how. You're one with the track record, and with you're part of the ecosystem. My question to you would be more from an industry perspective. What's the kind of learning that you could sort of share with other founders in terms of, getting the investor mix right up front, but to an extent, I'm assuming maintaining your autonomy. If I could just add another complexity to that question is, sometimes when the concept is very unique, which in your case it is, right? it's sometimes very hard to get investors onboarded, because let's be honest, the vast majority of investors prefer the herd mentality. They love being a part of the collective because they feel that they've diversified their risk. So sorry, long question, but I guess if it all kind of hones in, I'd be very, very keen to hear your perspective on that.
Yeah. I've got, two experiences of raising money for businesses. The SingLife story was tough, right? It was really hard to raise capital. SingLife was different because you couldn't, most investors want to see a business that's operating and has revenue before they invest. In my case, I couldn't get any revenue because I didn't have a license yet. And I didn't have a license because I didn't have any capital to go back to the regulators with. And I didn't have capital because I didn't have revenue, no revenue because no license, etc. So it was a tough gig to do. Also, we had to raise $50 million to start our SingLife business. And the number of investors that are willing to invest in a greenfield operation off a PowerPoint presentation and a little bit of Walter's personality, there's not many people that are going to take those kinds of risks. So SingLife took 3 years to raise the capital on. That meant eating baked beans out of tin cans, kids out of schools that were expensive, selling cars, downsizing houses, all of the stuff that founders have to do, unfortunately. We, as founders, when you believe in something, you have to believe it in every fiber of your being, because the stress that goes on us to deliver these things is all encompassing. And in my case, my personality is I'm like a dog with a bone. I don't give up until I'm dead, right? And luckily I got funded after 3 years. Otherwise, I would have probably taken the family and the assets off the cliff into oblivion. And fortunately, my wife loves me and stayed with me through it all, but we got it done. SingLife obviously was a great success. Yeah, we built a great business. We had fantastic investors coming on board during the process, and ultimately, when we acquired the Aviva business and brought on a private equity style of investors, everything changed again. But the value creation continued. When I decided that it was time to do something new again, I basically put a post on LinkedIn and said, hello world, time's come for me to part ways with SingLife, and I'm going to do something new. Watch this space. I'm super excited. And the next day my phone rang. So Chocolate Finance took 3 weeks to raise the money that we needed to start, whereas SingLife took 3 years. And so, Chocolate Finance has got two good things going for it. One, I didn't screw up SingLife so badly, so they thought I'm investable. And number two, I think the Chocolate Finance proposition is spot on and really, really works. So very fortunate to have Sequoia at the time, now Peak 15, to lead that round and have very, very supportive investors around around the Chocolate Finance table. There's a lot of advice to be had about how to structure things. In the SingLife days, as I went through, I was diluted down very, very low because I didn't have a choice, really. When you're eating baked beans, you'll take any money, and you end up having less of a share than you would have liked, no control of the cap table. I thought at the time that being the insurance expert would be the value that I add and the control that I had, whereas the capital investors were more financial in nature. Which did give me an ability to run the business my way for a period of time. But ultimately, when the time came to the big capital decisions, if you're not in control, you don't really drive the bus at that point in time. So Chocolate Finance, when we built it together, it was very important for me to stay in a controlling position. The way I discussed it with shareholders is, look, this is Chocolate Finance. Think of it like a bus, right? If I'm the driver of the bus. If you want to be on my bus, you have to sit at the back. If you want to drive the bus, you have to get your own bus. But at the same time, I'm still going to take some hey guys, where do you want to go conversations, and we do it together, right? But we go the route I'm going to take rather than the route you're going to direct me to take, if you know what I mean. So
I know what you mean.
There's a balance of how to deal with the shareholders, and I've been really lucky to have fantastic support, guidance, counsel, debate with the guys that are backing me at the moment.
And where are you in your journey? So you've done one round, you've done a couple.
Yeah, we've done one round.
Mm-hmm.
We did our initial round in 2022. We raised 19 million up front. We're about to do another back on the back of regional expansion. And what we found is that we've been so successful in Singapore in terms of what we've started, that the same solution is useful in other markets as well. So we've started specifically looking at Japan for the last 18 months or so. Japan is the biggest cash market in the world. And on the back of the market entry work that we're doing in Japan, we've raised a lot of initial engagement and awareness around what we're doing and investor interest. So we're going through a process now which will, re-up the cap table as we go through that next phase. We don't need a lot of capital actually, because the execution stuff is very, very light. But we do need solvency type of buffering as we grow, which we'll need as we build.
And the focus is more eastward, not westward.
The focus is on developed rather than developing markets. I think in our world, we are focusing on the cash and asset side of the financial services spectrum rather than the lending or credit side of the spectrum. Credit and lending works incredibly well in more developing markets where credit is used to fuel the ecosystems, whereas in our world of cash and asset enhancement, it sits much more neatly in places where the average GDP per customer is higher.
No, I agree. And I'm sorry, I should have qualified when I meant west. When I meant westward, it was more towards the Middle East, where actually we're more of a developed ecosystem. We're developing in another way, but I can actually see for the little I've learned over the last, I guess, 6 months to a year of knowing chocolate finance, that I think there's a clear need in this part of the world for these high yield, if I may say, cash accounts, right, where people are parking copious amounts of cash in their banks. Cash is, people, you think cash is always cash at hand. It's not cash. Cash at bank is also cash, right? And that's the market you're targeting. I'm going to come back.
That's right. But
sorry, go ahead.
On that though, we are in the process of planting some flagpoles for exactly that purpose. Exactly. So the beauty of Chocolate Finance Solution, as you say, is this is not a country specific need. Everybody's got it, right? So. Yeah. My issue is around how quickly you can scale based on the resources and things that you have without kind of upsetting your core.
Cool. Yeah.
But at the same time, these things do take a long time, especially from regulatory and other perspectives, to set up licensing and shops and all that. And you have to start that stuff pretty early. And so a lot of these things are already underway, but we'll announce them when they're more ready.
Yep. No, fair enough. Walter, you've been around, so I'm going to sort of pivot a little bit into the conversation. Want to kind of get a feel. We in the Middle East are, I guess, at the nascency of sort of emerging as a fintech hub. There's a lot of activity which is going on in Saudi Arabia and the UAE, Qatar, other parts of the Middle East, right? You've been in Singapore for a while. You've seen the evolution in Singapore. Singapore is now widely, associated as one of the top fintech hubs, which is incredible, right? For a country which is as small as 3.5 million people, right? How over the last 9 to 10 years, you've gone from an average run rate of about $20 million being invested into the fintech ecosystem to sort of nearly a run rate of about 4 billion, right? In sort of your words, right? Because I've had Swapnendu on the show, I've had a number of other founders, and I've asked the same question, but I do want to ask your view and saying, two parts to this question. One is, what have you seen evolve in terms of Singapore as a fintech hub, and sort of what role do you think the regulators played in it, right? So two parts to that question.
Yeah, sure. So I think the beauty of Singapore is that it is all the things you've described. It is pro fintech. It is respected and capable, and it's got an abundance of talent here to deliver cool things. The downside of Singapore is that it's small, right? There are only 5 million people here, and financial services is a low margin business, right? You can't really do a lot in one place. So The issue then is, how do you scale, and not just scale in Singapore? You have to scale beyond the shores of Singapore. The question then is, where do you go now? If you're looking at Southeast Asia as a total, as a segment, there's arguments to say, well, Southeast Asia is the new China/India, in terms of the size of the markets and the growth and everything else. But from what I've seen over the last years is that actually Southeast Asia hasn't performed nearly to the same extent as the China and India counterparts. And there's a lot of reasons for that. There is the diversity of currencies and cities and wealth disparities and all these things that kind of contribute to that. But Singapore, particularly as a center of all this, is in a position to generate capability which can be spread around the region. From a regulatory perspective, though, we have seen over the last while that the exuberance of FinTech led in the beginning to potentially a more open attitude from the regulator than may have been otherwise warranted. I think a lot of things that have happened over the last 10 years have sometimes led to not the best outcomes, right? So some businesses haven't worked out so well. The flow of the attraction of funds into Singapore has sometimes met AML issues and other things which have all kind of happened along the way. And as a result of that, you now start to see the tightening of regulation. Yeah. And so what we're seeing now is that good businesses face far greater scrutiny now than ever before because of the success, not in spite of the success. Just because, things have gone well and now we need to kind of just, buckle it down a bit. What I think that does mean is that there are opportunities for places like the Middle East, which are going through what Singapore went through maybe 5-10 years ago in terms of the growth phases, to accelerate at a pace far beyond the pace that Singapore will continue to accelerate in the future. That's my view. But the branding of Singapore is inapproachable, right? Singapore is the most regulated, the most respected, the most structured place. But it's not where the growth is going to come from.
Okay, but I agree the growth has been more muted for a number of reasons. I think you mentioned one. I think you mentioned a couple. One was just the scale. I think with India, I tend to do more and more work with India. I think what I love about India is the scale, and I think a lot of the fintechs are actually solving problems that are real. They're solving it with deep tech. And they're solving it in a sustainable manner in an environment which is not easy. Trust me, as much as the kudos to the Reserve Bank of India and the other sort of regulatory authorities there are in India, India is not an easy place to do business, and definitely not an easy place to make money, which is why you see a number of Indian fintechs come to much smaller markets, because I guess the margins they can they can get in these markets make them attractive. Coming back to Singapore then, taking, a commentator's perspective rather than the founder of Chocolate Finance, where do you actually see the next bits of innovation to happen? I think you guys are doubling down on digital assets in a big way. There's more and more conversation on the topic. If you look at this year's SFF agenda, I think, digital assets is quite significant in its entirety in terms of the share of voice it's going to have. What's your take on that?
I'm not a fan, to be honest, of digital assets. Maybe I'm being older than 50 years old. Maybe that's not in my favor. But it's, to me, it's a token of something. Which either holds value or it doesn't, right? And if it holds no value, then the digital token is worth whatever someone's willing to pay for some nebulous thing. It's got nothing to it other than scarcity, right? And so
I get that on the currency side, but what about, bringing digital assets into the mainstream, right? Tokenization of real world assets, which does introduce a lot of liquidity. It could actually impact your part of the world. What you're trying to do by bringing
it can. So that has been the next phase. Is how do you tokenize or fractionalize property ownership or fractionalize paintings or whatever? Why do you need a digital token to do that? Can't an ordinary ledger do that?
Well, we could get in a debate. I guess we'll be two people who are at the wrong side of, I guess, their age equation having this conversation. But I think there's a whole argument. I had somebody else on the show last week, and they were talking about how they've created a life insurance company, which is on a DAO, which everybody is it's community-based insurance, right? And that existed 200 years ago, if not 300 years ago. That was the pretext on what Lloyd's was created on. They are convinced that the only way this operates in today's world is on blockchain, right? And it needs all of those features that it needs to. But okay, digital assets aside, where do you see in the Asia Pac region? Where do you see the next trends? What do you see as coming in and really fascinating, either B2B or B2C segments?
I see the next big trend as efficiency, streamlining, process enhancements. We've spoken about, obviously, on-prem to off-prem data was the first wave of all of that stuff. But I just see the whole evolution of, don't repeat yourself tasks. I don't know if all of the stuff of things that people do all day long, which are just processes. I see the next evolution of technology wiping out things that just should be done by computers.
Yep, agents are going to replace AI. Agents are going to replace all of us.
Not all of us. I think there's a lot of guys. A lot of people have to make the agents.
Yeah. Well, fair enough.
And a lot of them have to tell them what to do. But I think that's a real evolution coming, which is actually in the best in consumers' interest, right? I'm a consumer guy. How do we create good value for customers? Now, some people say it's by creating better products. A lot of people also say it's by creating cheaper products, right? And cheaper products means less input cost, and less input cost means less all costs. And how do you reduce costs is to, digitize, optimize. And so I really think that's where the next wave is going to come from.
Yeah, and I think that's pretty much what AI is telling us, or at least AI and some of the associated ones. I'm going to swing right back to SingLife, right? We didn't talk much about it. You talked about the challenges you had in terms of raising the funds. It took you 3 years. You got it going. You scaled it to, I forget what the exit value was when you exited, but it was a sizable chunk. Talk a little bit about the challenges you had as a founder in scaling SingLife once you were over the initial hurdle of getting the money.
Yeah, sure. Look, SingLife was a challenge. A lot of people said to us, well, why does Singapore need another life insurance company? Aren't there enough life insurance companies? And we did have the advantage of digitization and the strength of Singapore as a financial island that is very attractive to foreign wealth coming in, which gave us a lot of impetus. But the initial growth all came from digitization of past processes. This is why I'm such a big fan of optimization of stuff and cost reduction, because it actually generates value. We could offer a life insurance policy quicker, faster, and cheaper because it was just more efficient the way we did it, right? We were very lucky. Again, the SingLife brand resonated very well. Again, branding is positioned very well. The way we came to market with that brand worked both locally and with foreign money coming in. We did have challenges along the way around how to grow. The first one was, okay, well, when we started, it just went like that. And then we were just doing digital online sales. And you realize all of a sudden it went like that. And all of a sudden it just did that. And you don't know why. And you realize actually, well, either I've run out of digitally savvy customers or I've run out of friends who are going to buy my product, right? So you then have to think, well, how are you going to get the next lift? And so what you then did was you said, okay, well, how does traditional insurance get sold? And it's through advisors. And so what we then had to do was take all of our digital capability and transform the same capability, but allow an advisor to use that efficiency, not just a direct to customer. And then, of course, the whole thing went up again, boom, like that, which then made a whole lot of sense. And then when that started to slide, you think, well, actually, what's the next evolution of distribution? And that's where we came up with the idea of the SingLife account to build your own bank kind of product as we go along. But I mean, there's thousands of challenges as we go. We were pushing the boundaries on regulation. We were, when we started SingLife, there was no facial recognition type of hold your passport up stuff. Mm-hmm. And how do you get, the regulator to kind of agree that was better than a piece of paper and a check? So that stuff takes forever. I mean, you look at it now and you think, oh, well, everybody does that. It's like straightforward. But in 2017, that was like, no one did that, right? Yep. And so to get through those hurdles as you go, when we put cards and payments into our business, it had never been done before. What insurance company has integrated a debit card into its actual policy, right, as a payments mechanism? A lot of companies have used third-party cards and stuff before, but to actually run it off the same chassis, because of all the efficiencies that they can generate, of course, that took forever to get to common ground with the regulator on to find a way. Just we're doing things for the best interest of customers, right? Scaling was always the thing. So everything about business is about scale. We were lucky to have an opportunity to acquire Zurich along the way. Zurich Life was leaving Singapore. We did a fantastic little deal with them to port over their customers. And because our tech was super cool, we actually just lifted and dropped their entire portfolio into ours. There was no technology cutoff or like transitional services agreements. Just boom. It was the greenest dashboard I've ever done. And in my previous lives, I've done integrations and things before, but that was just perfect. But then the real win came when the Aviva business became available for sale, right? That was a real scaler. Aviva had things that I wanted. It had a significant amount of cash flow coming through from profitability, which I needed to fuel this account creation that I was doing. It had deep product capability. It had 1.5 million customers, and it had distribution, right? And I wanted to take all of that and put it into my SingLife rocket ship. But we were working through that process, and COVID hit, yeah. And in midway through dealing, and all of a sudden it's pens downs. Everybody's running around trying to figure out what the world's going to happen to the world. So to pull all that stuff off during the COVID period was. It was an awesome achievement for us to get it all done, but it wasn't easy. Yeah, it wasn't easy.
I can imagine. So, Walter, conscious of time, I guess my last but one question. You, if I remember correctly, you were with HSBC, right?
Yep.
Then you went on to establish SingLife. Now Chocolate Finance. For young budding founders, what are your sort of, what's the gospel here in terms of, the do's and don'ts? No, go ahead, please.
I mean, there's hundreds of pieces of wisdom here. The one thing is always, experience is useful. Yeah. I've seen a lot of founders who think they're going to change the world, but they don't really have a real understanding of what the world is that needs changing. And so sometimes a little bit of gray hair or no hair or learning in a corporate environment is kind of valuable before that journey comes along. Number two, learn everything you can all the time. Talk to as many people as you can. As a founder, if you're sitting in a back room coding, you will die. Yeah, your business will die. You cannot be doing that. You need to be figuring out how to lead through this stuff. Founders spend most of their time talking, raising capital, selling. Founders are salesmen, but just don't get paid. But that's what we do. Right? You sell all the time. Yeah. There's always a little bit of right place, right time. When I left HSBC to start SingLife, I had a really, really big job offered to me in the HSBC group, which I turned down to do it. And that was, my father-in-law had said to me once, if you want to start your own business and you don't do it before you got to do it before you turn 40, because after you turn 40, you've then got too much to lose. Yeah. And so I was 42 at the time, and I thought, well, it's now or never, right? And worst case scenario, I can always go and get another job. So the other advice is, make sure that you remain employable, regardless of your outcomes. I think founder journey is probably the biggest learning journey you can ever come through. What it puts you through in terms of your capacity for development, learning, leadership, problem-solving stuff. Whether you win or lose as your entrepreneurial journey, those learnings will always be useful for you to the next one, right?
No, that's good advice. That's also a clear suggestion that I'm too old to now set up a startup, so I'll give up that dream. I'll remain a frustrated entrepreneur.
But you have no hair, so you have some experience.
I do fit a couple of those criteria of success, but actually the one that your father-in-law said, I fail miserably now. So, and I think that's been the most defining one. Last question. I think you've partly answered it already, but just before we sign off, what's next for Chocolate Finance in terms of product, in terms of markets? If you just kind of sum it up as our last question or last answer.
So like I said, Chocolate Finance is taking the position of enhanced yield on alternative cash solutions as the entry point to its financial services offering. Right? Around that, we will be building all things finance within the construct that we have, and you can just imagine what that would be. From a geographical perspective, as I said, Singapore is the most awesome place to build a business to start. You learn a lot. You're governed better. You're structured well, and it is a small market where you can learn. And average customer size is big enough to survive. But the real scale comes from expansion. So world domination is what you can expect.
Oh, great. And we hope to see you in this part of the world too, with Chocolate Finance. You're always welcome to come as a tourist too. I will hopefully get to see you in person in, I think, less than 3 weeks in Singapore when we're at SFF. But, lastly, thank you. Thank you for taking time. I know it's the middle of the afternoon, so it's not that late in the day. I guess you've got a full day's work ahead of you. So appreciate you coming on, Walter. It was a pleasure as always. I'm quite sure that the listeners will have enjoyed sort of the width of the conversation we had. We talked about Chocolate Finance, SingLife, Singapore itself as a FinTech hub, and obviously your experience as a founder. So with that, I'll say thank you and goodbye.
Good stuff. Well, thanks for having the chat, and always keen to participate. Happy days.
All right, excellent. So ladies and gentlemen, that was Walter. He is the founder and CEO of Chocolate Finance. They've started out of Singapore, but obviously expansion is something which is on the cards soon. With that, I'll say goodbye till next week. Cheers.